Wouldn't it be nice to take a peek behind the scenes at SaaS businesses just like yours, or even better, businesses that are just a bit ahead of you so that you could see how your company compares? Is your 6% churn good, bad, catastrophic? Could your growth rate be better if you didn't require a credit card up front? How might offering a free plan affect your lifetime value? The answers to those questions are exactly what you'll find in this year's State of Independent SaaS report. We surveyed and compiled data from almost 700 bootstrapped and mostly bootstrapped SaaS founders. And in this video, I bring in Asia Orangio, founder of Demand Maven, who helped us create the report to go over a handful of the surprising results. And if you stick around to the end, I'll let you know where you can get your free copy of the full report, since there was way too much to include in this video. Let's get into it. Asia Orangio, thanks so much for joining me back on the channel.
Thanks again for having me. Super pumped to dig into all this data.
I am too. Let's dig in to your first finding. We're going to each have 4 that we're sharing today, but talk to us about founder count.
First and foremost, solo founders. Of course, you guys, out there, you're already making growth waves. Like, you're already doing the thing. And on average, and also the median, we typically saw on average, it was around like 17% month over month growth. When it came to the median, I think so just for context too, median represents more of like this is what most people are probably experiencing. And the average, of course, is the number that you get after looking at the entire data set. But even still, month over month growth, still looking pretty good. What I think is interesting, though, is there's a little bit of like a very slight diminishing return on the average when you look at founder duos, meaning like there are 2 founders. But what I think is fascinating is once you get to founder trios, meaning there are 3 co-founders, this is when you start to see around 2 to 3x average growth month over month. And I think that this is so interesting because I think the connotation of a trio is that maybe it goes a little bit slower, but actually I think having the third person probably, my hypothesis is that the third person probably breaks a lot of ties, so to speak. However, there are diminishing returns. Once you get to 4 or more, we start to see a dramatic drop off when it comes to average month over month growth. Not that it's like terrible or poor or anything. It's just not maybe as efficient as some of the other growth rates month over month. But I still think it's really interesting.
This has been relatively consistent since we started asking this question over the past, because this is the 4th report that we've done over 5 years, I think. And I've noticed this pattern in each of them. We could go back through the others, but I believe for some reason that, and I've never been able to explain it, that why 3 founders perform significantly better than 1, 2, and certainly than 4. I've always been with bootstrappers, like, we have the numbers in the report. I forget if it's like 70% of mostly bootstrap SaaS are single founders. It's like a huge chunk. And then another like 15+% is 2-founder companies. And that's just the most common. I mean, that's like the 85, that's a lion's share, right? 85%. And the more you get, like I've seen 4 co-founder bootstrap companies, usually there's a weak link is what it is. Usually there's someone who shouldn't, by my judgment, shouldn't really be part of it. And you get too many cooks in the kitchen and people can't, like you said, can't break the ties, decision by committee. There's all kinds of stuff. So it makes sense to me that at 4, it's too many. But I've always thought like, well, 3 is probably too many as well. But that's not what our numbers have shown us each year. My first finding, we asked, when a potential customer registers for a free trial, does your company request a credit card number to start the trial? And what we looked at in this case is over the course of the 4 surveys we did from 2020 to this year's 2024. And the findings are that the asking for a credit card upfront has increased and then decreased again. So the first year it was 73% asked for a credit card upfront. Then it went up to 78% in the next one. And it's down this year to 71%. So about a 10% drop. So it's not precipitous, but I am curious, Asia, to hear your thoughts on in the space, especially like with bootstrap founders that you talk to. Do you feel like the goalposts are moving for A, free trials, B, freemium, and C, credit card up front? Maybe start with credit card up front because that's what this slide is about. But have you seen that goalpost moving over the past several years?
Yes. with the founders and the companies that I work with, absolutely. It feels like there's a communal aha moment happening around the opt-out credit card requirement or the opt-out free trial, which basically means like you're requiring the credit card. I think there's a lot more movement towards opt-in free trial. And I think we'll probably also discuss a little bit about freemium as well, but definitely, I'm absolutely seeing this. I have some hypotheses about why, but we'll get into that in one of the future slides that we're going to cover.
Yeah, my default has tended to be if I don't have any other information, I ask for credit card up front, because usually I want to narrow the people who are going to try the software to folks who are actually interested and I think might pay. Now, it depends though. It depends on the space. Like if you're the person who's going to use the software is different than who's going to pay for it, probably not the best idea because they don't have a credit card, right? If a software developer at a certain company is going to use it but doesn't have a credit card, then obviously you might need to allow free trial without a credit card. The mistake that I've seen folks do is either enact freemium, where they then have, the bootstrapping and using freemium, where they push revenue down the line and maybe they don't have the criteria in place to do it. But also then they get a lot of noise, especially in the early days. And similar with removing credit card, you can get more people in, you can get more feedback, and that's the pro. The con is you get more people in and you get more feedback. And depending on how well you are at dealing with that, like if you're a first timer, that can be completely overwhelming. And so when I say I default to it, I mean, it's like a 60-40 for me. It's not an always never, but it's like with no other information, that's what I do. However, I think there's a lot of leeway here for it to go up and down.
That's so interesting. Because I'm the total opposite.
Is it to get more data? What's the reason that you would go with not having a credit card up front for a free trial?
If you already have a really dialed in sense of who your customer is, then I think why put the limits on the free trial? And also I find that when you are able to get a little bit more information, I just feel like assuming that you have help and that you have like experience in this, I'm actually very confident in my ability to detect like, okay, who's actually qualified? What do we got to do to activate people? I think to your point, if you're less confident in your ability to do that, then yeah, require credit card up front. But once you get to like 10, 20, 50 paying customers, I think that you can take the credit card requirement off and create more of a pipeline for yourself. But again, the assumption is that you've got a pretty dialed in understanding of the customer, considering that's literally what I do. I'm pretty confident in like, okay, yeah, like we don't have to require the credit card up front. But yes, I do think it makes sense though, if you're very, very early, maybe very new, first time founder, also new to SaaS, then requiring the credit card up front will be a really good litmus test. So I see a lot of value for sure in that. Yeah,
that's the key. Is I was referring to if you don't really know your ICP yet and you're still trying to figure it out. So that's the difference. Totally. Yeah, once you know your ICP, you're driving traffic, your ideal customer profile for those listening or watching, that makes sense. I think we're on the same page. All right, Asia, let's talk about target market.
Yeah. This might sound really obvious, but I think that this slide just illustrates it and makes it visual for people, because the market that you ultimately decide to focus on is going to have a huge impact on your growth rates. This also might not be that surprising when I say, but if you are targeting enterprise companies, traditionally speaking, your average month-over-month growth rate was probably like in the 26% or so. That's pretty high actually for a company. That essentially means that you potentially more than double year over year. But there are some trade-offs depending, of course, on who you target. So for example, if I look in this chart here, towards the end, we see consumers. So on average, month over month growth rate looked closer to 5% for consumers. Government was pretty slow, 1.75. Now, to keep in mind, this is the average. The medians reflected something very similar. But what was also interesting was, depending on just how people responded to the survey, if they selected other, which to be honest, I was kind of having a hard time of like, what would other be? But if you were not really targeting any of these, ideal customer types, then you probably saw contractions in growth. This could actually be due to a lack of focus. This could also just be maybe there are some customer categories that just don't fit within this model. But at the end of the day, who you target from a business perspective is going to have a lot to do with how you grow. That should be both, I think it should be seen a little bit as, I don't want to say like blessing and curse, but almost like setting expectations for yourself. So if you're targeting, if you're going B2C, if you're going consumer, just have a expectation that growth might look a little bit different than if you're B2B targeting enterprise or even mid-market. SMBs fell right in the middle, which probably not surprising. So if you were targeting small businesses, your average growth rate probably looked around like 12% month over month. But overall, though, something to keep in mind. But yeah, Rob, I'm curious how you see this and how this reflects for you.
Yeah. So for context, the top 3 fastest growing target markets are enterprise and mid-market, which is slightly smaller than enterprise, and NGOs or non-government organizations. I'm a little surprised the NGOs are there, but it is what it is. So those are the top 3, which the first 2 certainly line up with my experience of at least having a dual funnel with enterprise and mid-market plus SMB. But with the tiny seed companies, we see the ones with the bigger ACVs, the ones with the bigger average revenue per account per month or per year do tend to be the ones that grow faster. On the bottom end, the bottom 4 are totally in line with what I would think: aspiring entrepreneurs, education, so selling into schools and academics, consumers, and then government. And yeah, none of those are really surprising to me.
Yeah. NGOs, though, that makes me think that those software companies are solving a very big problem for them. Yeah. That's what makes me think that NGO is doing so well.
I think the NGOs are probably enterprise or mid-market companies is my guess. We've broken them out because we used to have, we do have other, and people would write in NGOs, that's our target market. And so we included it. But if you think about it, a lot of non-government organizations are actually large businesses. And I think kind of, the first 3 all line up. So for our next one, we asked, do you plan to seek outside funding for your company within the next 12 months? And I'm glad we started asking this. I think we've only asked it for 2 years, but it was insightful for me the first year to realize, this really gets sent out to the MicroConf, Tiny Seed, Startups, the rest of us ecosystem, which is frankly, it's just mostly bootstrappers. Like it's overwhelmingly folks who want to bootstrap, and that's fine. That's okay. What I was surprised by was in 2022, 30% of respondents said they plan to seek outside funding within the next 12 months. And then in this year's report, it's down to 23.5%. Now, a couple thoughts on that. Number one, it's interesting that across all the tiny seed companies that we funded, somewhere around 1/3 of them wind up seeking or raising additional funding. So that 1/3 number seems to be something. This is even for companies who've taken an accelerator round from Tiny Seed. The other takeaways from year to year, if you heard me say 2022 is 30% and 2023 was about just under 24%. So there's a decrease, right, of 20-something%. I think that's due to the funding environment. I'll say this, the 2022 results were actually surveyed in fall of 21 when things were still gangbusters. It was so easy to raise funding. Everyone was thinking about it. Everyone was doing it. The valuations were high. There were SPACs going on. There was crowdfunding going on, all kinds of stuff. So I do think there was more of an appetite because it was just easier. Money was cheaper. And this year's survey, taken a couple years later, because we skipped a year in between, is down to about 24%. And I'll admit, that's just not that surprising. I think with funding being harder to raise, kind of makes sense. You bootstrap until the money's available. And if the money's never available, you just keep bootstrapping.
Funding being harder to raise, but then also terms not nearly as appealing as maybe they once were.
There you go.
And then also, I think there's just like what was the quote from MicroConf most recently? The exit strategy is death.
Yeah.
I think the culture is culturing when it comes to bootstrap in general. So yeah. But I also think it speaks maybe a little bit to the mental resilience of bootstrappers. I think a lot of people are learning about how to grow sustainably, and also being maybe a lot more discerning about like when does it make sense to get funding.
And Asia, for your next slide, we have a battle of the models. Talk us through this.
Oh yes. Okay. It is one of my absolute favorite debates. And it's just because there isn't really like a right or a wrong answer, but the data is going to show us a couple of really interesting trends. So basically, there's, of course, offering freemium. Then there's the free trial. You can do opt-in free trial, which basically means that you don't require a credit card up front. And then there's the opt-out free trial, which means that you do require a credit card up front and you have to opt out of it. So when it comes to growth, churn, and LTV, which we're going to look at in here in a second, when it comes to growth overall, so what we find is free plans and free trials that do require a credit card, we're going to see on average at least 10%. And for free trial credit card required, it actually is the highest. So 14% month over month average growth for companies that do that. So requiring the credit card up front does have a pretty big impact when it comes to initial, upfront growth. And then not requiring the credit card, it had the least amount of month over month growth. So this was about 7.6, we'll call it 8% on average. And at first blush, that may seem like, oh, CC required for the free trial is the obvious answer. And then maybe after that freemium, but not necessarily, because now we have to look at churn. So for churn, for the free plan, this was absolutely fascinating, but basically your month over month growth average, while it might have been 10.45%, churn was about the same. It was almost 11% month over month average for churn. So basically, freemium tended to see, if you offered a free plan, you probably saw a little bit higher churn as well. When it comes to the free trial credit card required, the average for the month over month churn was 5.5%. Now, this was actually shocking to me because traditionally speaking, we tend to see really high churn numbers when you require the credit card up front because people forget to cancel and they email you and they're like, oh, I forgot to cancel. Can you cancel my thing? And then ProfitWell and a lot of other subscription metrics will actually count that as churn, even though they might have just forgotten. So I was actually shocked to see that the average was about 5.5% on credit card required. And then finally, not requiring the credit card on the free trial, 6.34, so a little bit higher. Now, again, that might make you think, oh, wow, not requiring the credit card on the free trial is the worst one. But then we're going to look at LTV. But first, I'll pause here. I'm so curious, Rob, like your gut reactions to this.
It's tough because it is averages. But my gut feel is typically that folks who are asking for a credit card up front, I would think that the churn for the first 30 or 60 days would be higher. But if they have their stuff dialed in, then beyond that, as long as they're getting ICP, their ideal customer profile in because they are gating it with a credit card, kind of makes sense, right? That's why I say it's my default. Again, it's a default. It's a rule of thumb. It's just a thing that I lean towards. So it does kind of make sense. It really makes sense to me that free plan, meaning freemium, has, I'd say lower growth, but that the churn is high, which I guess this isn't churn from the free plan. This is churn from the paid plans, which almost tells me like the business is broken. And that's the thing. Just bootstrappers using freemium in general usually means they don't know what they're doing. Like that's been my experience. You know what I mean? And it's like, I don't mean that. I use that bad word only to imply that I just see it too often. It's the same thing. People want to do B2C. They want to bootstrap a two-sided marketplace and they want to have freemium. I don't know why they're drawn to this like moths to a bug zapper, but it really is the most common questions that I get. I've just stopped taking these questions on the podcast. So the freemium part kind of being a train wreck and the business being on fire, that makes a little more sense. The fact that free trial with credit card require performs better, at least with these averages, I think is in line with my experience, but it doesn't, more questions to be asked is how I feel about it.
This is where I would say the story flips a little bit. So LTV, ultimately, what that KPI speaks to is the lifetime value of the customer. So for as long as they spend with you, how much like actual money do they spend on average across their entire experience with your product? And what we found was, while the free trial credit card not required certainly did not look as appealing month over month growth wise or even churn wise, what we found was it actually would have on average 2 times the LTV versus other plans. So for context, free plans and freemium, we saw an average of 3K LTV, When we looked at credit card required on the free trial, it was about 3.6K LTV. Free trial credit card not required, 6.5K. So easily 2x over freemium or free plans. And then, of course, a slight bump over the over the free trial credit card required. What this tells me is that while businesses might choose, the free trial where the credit card is not required, what they're basically trading off is faster, maybe upfront month-over-month growth for basically more money in the pocket, which I don't think you can be mad about. However, that's not to say, though, that requiring the credit card upfront is not a good option. If anything, this makes me think that maybe monetization is a little bit broken for companies that tend to do the credit card required upfront. And then for freemium, it's exactly what you said before. I think a lot of founders just don't really understand how to make freemium work. Like, how do you make it do the thing? But it also could speak to lower pricing plans and charging less in general because you've got freemium as your starting point. So it could also speak to that as well. So maybe monetization is a little bit broken here as well.
Yeah, this one's interesting for me because in our last slide, we looked at growth rate, and free trial with credit card acquire was growing significantly faster month over month than the others. But free trial credit card not required has significantly higher lifetime value, even though the churn is higher. So it implies that without credit card required, that basically they're charging more, right? I mean, because for the LTV to be higher with higher churn means they have to be charging more.
Charging more, keeping
This
more,
really-
I think, too, potentially.
This is where data can be made to tell a story, because Asia and I could go on Twitter X and we could say, well, obviously based on this slide, you should not ask for a credit card, and we have data for it. And we could flip to the slide before it. We could say, obviously by this slide, free trial credit card acquire allows you to grow faster. And I won't say it's apples and oranges because they're related, but it's unclear. And honestly, this is why the answer is it depends. It really does depend on your space. It depends on your customer type, your ICP. It depends on your stage. And for our last slide, this one will be quick. I just like looking at it because the question we ask is, please select up to 3 advertising channels that have most significantly increased your revenue. And the number one is with 65%-ish is Google AdWords. Number 2 with about half, that's around 30-ish, is Meta or Facebook ads. And then next is other, and 4th is LinkedIn. And every year I'm always like, I think Twitter ads are going to do something at some point. They're going to, and they never do. They're always so far to the right. It's like that Twitter ad ecosystem is terrible. Usually though, I would expect LinkedIn to be 3rd. It just in broader experience, it's like AdWords, it's Google AdWords, it's Facebook, and it's LinkedIn would be my top 3 that I would recommend to founders, B2B SaaS founders. The issue though is the LinkedIn ad tools are not great. And that's what I've heard. And so we've actually, Tiny Seeds invested in Linklo, which is a SaaS that it sits on top. It's like, it helps you manage and deal, basically get around LinkedIn's crappy ad interface. You heard me say that's not their marketing. That's me just saying it's pretty rough. The ad tech of LinkedIn is significantly behind Meta and AdWords. The thing that I want to dig into, and I wish I had this data with me today, is other advertising. I don't exactly know what that is, and I bet we had a text field that people entered stuff. I'm curious if other advertising is like advertising on podcasts, advertising or sponsoring events, or display advertising. Like I can imagine those being an other. And so the fact that it's ahead of LinkedIn might be just that it's so varied. There's so many different options that people kind of bucket it all in one.
Yeah, the LinkedIn thing is also not surprising to me. I think in order for LinkedIn to work, you've got to be targeting an audience that just actually lives on LinkedIn. Like I live on LinkedIn. That's where I hang out now.
Asia, thanks again so much for joining me here in this video today. Folks want to keep up with you. You are Asia Orangio on Twitter and demandmaven.io if folks want to see the growth consultancy that you run. Thanks again for joining me.
Thanks again, anytime.
I hope you enjoyed that look into the State of Independent SaaS report. You can head over to stateofindysaas.com if you want to get your hands on the rest of the report. In it, we walk through dozens of SaaS metric benchmarks. We talk a little bit about our methodology and comment on the most surprising findings. And I also cover the content about hiring that was on my 8th slide that we didn't quite have time for in this video. If you found this video helpful, make sure you like and subscribe. I'll see you next time. Thanks for watching.